Good morning, everybody. This is the live market open for Friday, January 8th. We're finishing a very, very busy week, the first week of 2016. It's Friday. Happy Friday. I'm Yohay Elam, Forex Expansion Market Movers podcast, doing the show as usual for fxstreet.com. As usual, we'll cover recent developments, charts and levels. We had some kind of a roller coaster all across the board, and we'll talk about the next, less than 24 hours, and do a preview for next week. Most importantly, I'm looking forward to hear your questions about what's going on now in the markets, about what's going on, will go on later today, next week, and also the 2016 outlook that we did here on Wednesday. If you can't see the chat box on the screen, please go to the address for the chat here, tlk.io/fxstreet-forex-live-video. So, before we talk about the indicators, because indicators are sort of playing second fiddle, at least for now, to market mood. Okay, maybe your dollar chart can explain basically everything. Okay, so yesterday we had a gloom and doom mood in markets. What does gloom and doom mean? Falling oil prices because of lack of global growth, worries about China, falling stock markets, and safe haven currencies were on the rise. Euro returned to its role as a safe haven currency and was also a bit fueled by the better than expected unemployment rate. It fell down from 10.7 to 10.5, and that's good news, signs of growth in the Eurozone. But it's mostly the mood. So the mood sent the pair up, the bad mood, and when the mood when the mood improved during the night, then we had a fall back down to this battle line of 108.80. We've already been at higher levels. Now, the mood improved. Why? Because China took a few more steps. They're taking lots of steps every day. This time they announced already yesterday that they're going to remove the circuit breakers. Okay, they're not going to shut markets down if they fall too much. But what they didn't tell us, and probably did do, is intervene in markets to keep the markets from falling. The Shanghai index and also the Chinese yuan, I think they took some action to limit capital outflows. It's more under the table. The way that they set the value of dollar yuan is a bit unknown, but it seems to have stabilized. And we have better than sort of rises in Japanese and this Japanese stock market, other ones in Asia, in China. And of course, this implies also better futures for the S&P in the United States and a weaker euro and a weaker yen. Okay, so levels to watch in euro dollar. Still 109.50. This 108.80 level, which we're currently trading on, is more a pivotal line, a battle line. Below, I would say that 107.60 is some kind of support, followed by 107.10. It all depends now on the non-farm payrolls, and we'll talk about that soon and more in detail. Okay, let's skip to another safe haven currency. Same phenomenon here. We had doom and gloom yesterday, falling to new lows, 117.40. We could put that as a line, draw that as a line. Okay, and then we had a recovery, a stronger dollar, and most importantly, a weaker yen, less demand for safe haven, especially as stock markets, especially in China, recovered. Okay, so that's really the safe haven flows. Regarding also in that context, yesterday we had a fall in oil prices all the way to 32.08. So WTI crude oil fell to the lowest levels since 2004, joining Brent crude, broke below the crisis low of 2008-2009 of 32.70. But then again, now things look better, and we're back to 33.88 at the moment, around 34. I would say that the previous low of 34.20, that I can't find it now, or here it is some kind of resistance right here. Okay, so these are the lines if you're trading crude oil. Another thing that happened related to oil yesterday, that we had a report that Saudi Arabia bombed the Iranian embassy in Sana'a, the capital of Yemen. And of course, it's another escalation in the tension between the two big oil-producing countries, the two big neighbors there in the Persian Gulf, and that also helped the price of oil to move a bit upwards. Okay, but in general, there's just too much supply of oil anyway. When we have a better mood about demand in markets, that means, okay, there's enough demand to absorb the supply. Tensions in the Middle East relate to supply, and as far as I can see, they're usually temporary. Okay, so that's what's going on with oil. Okay, let's talk about other events and other currencies. Let's talk about currencies. We had the pound falling to new lows. Also, the pound fell to the lowest levels since the pound is reacting more like a commodity currency. So it suffered yesterday when the mood was bad. It fell to lower ground, fell to the lowest levels since 2010, broke below the lows seen last year, below the 2015 lows, and it reached 145.20 something over there. Maybe let's put a line to see where exactly that is, so I won't be talking in the air. 145.30. Currently we're back above 146, so a bounce from the lows. If you want, you can see there an inverse head and shoulders pattern. I'm not so sure about that. Anyway, I think it's until the next gloom we'll see it fall. We have one figure from the UK later today. Dollar CAD, of course, influenced by oil. We had it reached dollar CAD new highs. Each time I see the sky's the limit, there are no real resistance lines over there with dollar CAD. So yesterday we reached this new high of 141.70, and then we fell under 141 once again, currently 141.07. Again, everything mood related. Okay, bad mood, weaker Canadian dollar, stronger dollar CAD, better mood, and the pair falls back down. Everything is related to oil prices. I was talking yesterday also about another Canadian event. It was a speech by Stephen Pelosi, the governor of the Bank of Canada. And I was talking about perhaps he was going to hint about interest rate cuts. But no, he was very, very positive. He also talked a little bit about, or more than a bit, about the exchange rate. So the governor of the BOC in Ottawa, Pelosi, says that the weakening of the Canadian dollar helps the Canadian economy quite a lot. Of course, that the fall in oil prices is not good for the economy, but the fall of the Canadian dollar allows other sectors of the economy to have a better competitive edge, especially against the United States. And he's also optimistic about U.S. growth. Of course, we'll learn more about U.S. growth later today with the NFP. Okay, so it also helped the Canadian dollar not reach the stratosphere yesterday. Dollar CAD, but it remains vulnerable to too much supply in oil. Let's move to other currencies. In Australia, we had the retail sales coming out as expected. Australian dollar had an interesting move yesterday. It fell below 70. Okay, it reached 69.80 with the bad mood. It just exacerbated the fall. Of course, the Australian dollar is related to China, even though domestic figures are a-okay. So we're back to the range between 70 to 70, 64, 65 as markets did stabilize overnight. Okay. Now this morning we're seeing a fresh fall in the Aussie dollar, a fresh fall I think in the loonie, and euro dollar rising once again. So this morning we have a reawakening of the bad mood. It's not as strong a move as we've seen yesterday and overnight with the Chinese stock market open, but we should note that the mood in markets, and you can see that also in falling oil prices in the past few minutes. Weak oil goes with the weak CAD, weak Aussie, weak pound, a stronger yen, stronger euro. That's what's going on in general. Kiwi dollar, I don't think we had any news recently. It dipped also below 66 when the mood really worsened, but it's more stable. Milk prices are relatively stable, and we're back to the 66 to 67 line. Dollar Swiss, well, with the strengthening of the euro dollar, so we had also this pair sort of fall. Stronger euro means stronger franc. We're back under parity once again. We hit a low of 99.20. Maybe that's a double bottom here, but remember, technicals and fundamentals work less in the Swiss pair because of the interventions. As usual, Euro Swiss is deep in the 108 handle. 107.60 seems to be the line in the sand for this SNB to intervene to balance this pair. We had a big move in euro pound. Okay, so the pound is now reacting like a risk currency, a commodity currency, if you wish. No commodities there, but well, only a few in Scotland, the oil. But anyway, what I want to say is that euro is a safe haven, pound isn't. Big shoot up in euro pound, getting closer to 75, now a bit lower, 74.50, but clearly out of range. It made a clear break above the 74.10 level on this gloom and doom. The safe haven tandem pair euro-yen has seen a stronger euro in comparison to the yen, but the moves here aren't as huge as in crosses that involve a risk currency and a safe haven one. Anyway, we're at 128.80, 129.75, 130 work as resistance. The lows here of 126.90, I would say, no, 127. I think we can see here some kind of a double bottom. So maybe that's a line to look at if you're trading this cross. And one of your favorites, pound yen. Well, also here we had, this is a clear reflection of the changes in moods, but in a much more accentuated, much more emphasized manner. We had here a dip under 171. Now we're close to 173. Once again, it's a bit mad out there. You have to really, everything is mood related, not related to Japanese fundamentals, nor British fundamentals. Okay, we've covered quite a lot. Before we continue, we have here a comment by EdsFX. Bombing Iran embassy is the same as bombing Iran itself because embassies are sovereign soil in other countries. It's a mess in the Middle East, and China has boots on the ground in Yemen. China has boots on the ground in Yemen, and China also has the yuan in Zimbabwe now as their currency. Well, I'm not aware of boots on the ground in Yemen, but I certainly agree that the Middle East is a mess. It actually has always been such. Remember, I think that Saudis want to keep oil prices low in order to keep Iran out of markets. On the other hand, higher tensions in the Middle East lift oil prices, and Saudi needs higher oil prices. In general, countries all over the world, this is global, when things get worse, they try to find an external enemy, and I think these countries might be doing that. Anyway, so far each time we had a small escalation, and then we, at least here at the West, have a very short attention span, so we shift our attention to something else. Okay, so now let's see if this really turns into a bigger mess, or these tensions will subside once again. Comment from Fabian: how's the bad mood in euro-dollar will affect the interpretation of the NFP data? Well, going to reach the NFP quite soon. I'll just say that this one is a bit more complicated than previous NFPs, and for several reasons. Okay, let's cover other events for today. Well, there aren't too many. Let's see if I haven't missed anything. Oh yeah, what we had earlier today is German industrial output and trade balance a bit under expectations, but nothing to move the euro too much. Okay. Today on the agenda we have very few events. We have at 9:30 UK trade balance. It can have some impact on the pound, but not huge. It's not really a really huge event. And of course, at 1:30 GMT, 2:30 here in the old continent, US non-farm payrolls and the Canadian jobs report. About the non-farm payrolls, let's talk about the data first. We're expecting around 200,000, according to the official expectations published on all your calendars, Bloomberg, Reuters, wherever you wish. I think the real expectations are just a bit higher, not much higher, because we had a positive employment component in the ISM non-manufacturing PMI, and we had a better than expected ADP. But this also has a caveat. The ADP report, which was much better than expected, 257,000 against 192 expected, a huge positive surprise, was then shrugged off, disregarded as being influenced by seasonals. influenced by retail hiring because of the Christmas shopping, and that it isn't a real reflection of what's going on in the real economy. Now, if we have doubts about ADP, it doesn't mean that these doubts will reach also the NFP, right? Because there are more doubts about ADP, and ADP is not always well correlated with the NFP. But remember that this makes it more tricky. Another thing that makes it more tricky is that we already have, it's the first non-farm payrolls, it's the first NFP report in which we have a rate hike already behind us, okay? So, and nobody is expecting a rate hike in January. We have a Fed meeting, I think, on January 27th. There's no press conference. The Fed made it clear that everything is gradual, so no press conference, graduality, no rate hike in January, right? The big focus is on March, but March is a bit far away. It's until the March decision, we have two more NFPs apart from today's. We have in early February, the report for January, and in early March, the report for February. In mid-March, the Fed will already have already three reports and will already have GDP reports, retail sales, industrial output, so many other things. So this is a bit far away. So this makes it also a bit confusing. So regarding euro dollar, it could be a bit wild out there because, of course, this confusing report, it could be skewed to the upside and markets could disregard it. It could be, it's the end of a very, very intense week with everything Iran, Saudi Arabia, the North Korean H-bomb. We had also something small in Paris. And of course, what's going on in China, the roller coaster in Chinese markets, in global markets. So I think it could be one of the more complicated things. My suspicion is goes as follows. If I think we're now still in this kind of risk-off atmosphere, in a bad mood atmosphere, and this is different from the reaction we could have had beforehand. Okay, so let me sort of make my scenario. I may be right, I may be wrong. If we have a good NFP, and it doesn't mean only the headline, but let's say we have an excellent report. This means for the Fed that it's going to raise rates less gradually, faster, okay? More rate hikes in 2016. That's the initial interpretation. If we have more rate hikes, we might have more worries in stock markets. Sort of, this could be a sour mood for stock markets. It could have the reverse impact. That means a rush to safe havens. That means a rush to the euro and a rush to the yen. So this is, of course, a bit complicated. I'm not sure this will really materialize, but we might have a scenario in which we have an excellent NFP and the reaction is a stronger euro dollar. Not in the first 10 seconds, not in the first 5 minutes, but let's say after half an hour, markets are going to think, oh no, another rate hike coming too soon and too many ones coming afterwards. This could be a disaster. We already have so much trouble in the world, not enough demand. China is going down. Oil prices look bad, and the Fed still insists on raising rates. Oh no, let's go to the safety of the euro and the yen. Okay, so that's one scenario. Anyway, it's a bit complicated. NFPs are always complicated. Let's talk about the other figures that we have in the NFP. It's not only about the headline number. Of course, it's also about revisions. We always have some kind of revisions. They used to be always in until mid 2015, they were mostly positive, and then we had a mix of positive and negative revisions. Second thing to watch there, of course, another headline grabber is the unemployment rate. It stood on 5%, expected to remain at 5%. If we have a fall to 4.9, even if it's not big, it's going to be significant because it's a round number. That's the main reason. And the 5% unemployment rate used to be considered the Fed's sort of Nairu rate, the rate at which unemployment, low unemployment already turns into wage pressure, which in turn turns into higher inflation. Okay, so that will be significant. I think it's not that important. The unemployment rate is always good. It's always influenced by the participation rate, which has risen last month, and that's a good sign, but it still has very low levels. So I think it's 62.5. So if we're stuck, if we have a fall in the unemployment rate with a fall in the participation rate, I don't see that as very exciting. If we have a fall in the unemployment rate with a rise in the participation rate, that's of course excellent news. Okay. And wage growth. Wage growth is key. In the report for November, published in early December, just before the rate decision, we had really great news. We had the year-over-year level rise to 2.5%. It broke above the 1.9 to 2.3 range. It showed an acceleration in wages. Higher wages mean more spending, and more spending means more inflation. The second target of the second mandate of the Federal Reserve. Okay, in December it did fall to 2.3. Sorry, in November. No, we had the report in December for. No, sorry, I confused you guys. In October it reached this peak of 2.5. And the report was published in November, and the report published in December for November showed it slide back to 2.3, which is also okay. Let's see what happens now. We have only, or at least I have only, a forecast for the month over month, which is supposed to be sort of within the normal average of 0.2. Any small rise above that will be positive, will mean also that the US economy, that people not only have more jobs, but that these jobs pay a bit more. Okay? There are other figures to watch there, such as the real unemployment rate, U6, and private payrolls, average work week, things like that. But I would focus on the headline number and year-over-year wage growth are the two most important things in the non-farm payrolls. But as aforementioned, because of this sort of turbulence in markets, worries, bad mood, I think we could see not the typical reaction from euro dollar. Okay. And another thing to say about this special report is because it's not so special, because markets are not focused on indicators. It's still non-farm payrolls. It's still the most important release for in terms of indicators. It's the last one for 2015. We will also have the sum up for 2015. Of course, we'll have revisions afterwards, but it's still sort of some kind of summary. And but we've seen on Wednesday, for example, when we had really important figures in the United States, we had the ADP NFP, we had the Fed minutes, we had the ISM non-manufacturing PMI. All of them had some impact, but less impact than normal. The markets are sort of fixated on China, and other, of course, geopolitical issues. So so it looks a bit more complicated. In Canada, we're expecting a rise of, well, let's look at the chart, at the calendar, sorry. Today, in Canada, we're expecting the unemployment rate to remain at 7.1%, which is sort of, well, above the lows, but it's still okay. Okay, so if you look at the Canadian economy beyond oil, it's okay. And in terms of jobs, it's very, very volatile here in Canada. But after a fall of 35.7K in November, now we're expecting a rise of 10K. Also, will surely have an impact on the Canadian dollar. But again, markets are looking too much at the price of oil, at stock markets, at the gloom and doom, and the suddenly bursts of hope and recovery. So, but also for the Canadian dollar, of course, it's a big event. Towards the end of the day, we also have other figures in the US, the wholesale inventories. It's not so late in the day, but not usually doesn't have a big impact. And consumer credit late in the day, not expected to have an impact. Of course, the non-farm payrolls is the big event of the day. Back to the chart, 108.80. Any questions about the non-farm payrolls, markets, any specific currencies you'd like me to cover? I see quite a few of you here in the chat room. And we have time, I think. Yeah, we have time for questions, of course. Yeah, so the world is clearly divided into safe haven, euro yen, and all the rest. At some point during this week, we had weak inflation figures. Early in the week, we had weak inflation figures from Germany, and the following day from Europe, from the eurozone, and that sort of made the euro more vulnerable. But that seems to have gone. Question from Fabian: what do you consider surprisingly good, average, surprisingly bad NFP figures that could significantly move euro dollar, and to what extent? I would say that I think that markets are in practice expecting about 210, 220. I would say that 250 is sort of a round number, more round than 230. Anyway, that would be sort of significantly positive, a really good surprise. In December last year, the report we had in early January, we had the headline figure shouting out 325,000. That was revised afterwards, but anyway, that was sort of a huge positive surprise that sort of lifted expectations for a rate hike already in June. And we all know we had the rate hike only in December, but it's sort of what this could be even above 300,000 because of this seasonal skewing. Negative, I would say that the headline would be under 180,000, 170,000. We already had quite a few negative reports in the past few months. August and September were just terrible. Then we had a recovery, of course, but last month we had 211,000, which was okay, which was sort of more than good enough for the rate hike. Here's the small slide I did last month. So last month we had 211,000 jobs gained, 35,000 additional in revisions, wages 0.2 month over month, which is what we're expecting now, and 2.3 year over year. Unemployment rate remained 5%, but the participation rate was rising from 62.4 to 62.5, and this made the stable unemployment rate look better than the headline suggested. Okay, so I would say under 170 and above 250 would sort of be a significant surprise. But remember, especially if we have something in the middle of the range, that that we're expecting, that we should look at wages. Wages rose, if they rise better than 0.2, even just 0.3, it's good news. If wage growth is above 2.3, that's good news. If it's only month over month 0.1 or no change or falling wages, and year over year it's back to the old range around hugging 2%, that's of course negative. Okay. Remember, regarding euro dollar, we could see extreme reactions because we have so many factors moving this pair: the safe haven flows, the crazy market psychology, expectations for the ECB in 2 weeks. Really, it has become a bit more complicated. All right, any more questions? Let's see if we have more news coming out. Oh, yeah, I see a question here. top bottom range of euro dollar volatility. It's really hard to tell. I can just mention a few technical levels. 109.50, 110, of course, the very round number, 110.70, in case we have an extreme move to the upside. On the downside, we have 108, let's say the round level of 108, 107.60, and 107.10 is becoming more significant support. Below that, we have 106.30 and 105.20. I think perhaps the worst scenario for euro dollar, if you want to go short on euro dollar, would be an okay report in the United States. Good enough, as expected. No surprises to the upside or to the downside. No changes. The market will focus elsewhere, and the mood perhaps today could be a bit more positive after China managed to stabilize its markets, and that could be negative for euro dollar. Less fear, bad for euro dollar. I think if we have a really, really positive surprise, it could mean more rate hikes. The markets might not like that, and that could be negative for stock markets, and positive for euro dollar. And if we also have a bad figure, it could also, in a very weird way, but it's still possible, that we'll have sort of doom and gloom. Even the United States cannot grow its jobs, everything. We're all going to hell. Let's go to the safe haven currencies. Okay, but really the mood changes all the time. It's jobs day, the first one of the year, and it's a Friday, of course, and things can become quite complicated. I would say perhaps a better currency pair to trade in terms of reaction to the non-farm payrolls would be pound dollar. Why pound dollar? The pound is reacting. Pound dollar is reacting more in a more normal way. Okay, in regards to the US dollar, and it's not influenced by commodities. It is influenced by the mood, but not by commodities. It doesn't also have the. In Canada, for instance, we have the Canadian jobs report, making dollar CAD more complicated. For the yen, which is usually provides the best reaction to the NFP, we also have these extreme safe haven flows. So I would say it's a complicated day. I think I've used this word perhaps too many times this morning, but yeah, that's how I think things are going. Any more questions? Yes, we have more questions. So you see maximum 200 pips reaction, or can it move even more given the present volatility? It can move even more. I just mentioned a few lines, but who knows where it's going to be? I mean, we have could have more safe haven flows, pushing euro dollar even above. Yeah, 200 pips is exactly 110.70, but we have lines above that as well, 111.30. This week has been characterized by high volatility. Of course, there's even higher volatility in crosses involving one safe haven, and on one side a safe haven currency, and on the other side a risk currency. So, for instance, Aussie against the yen, CAD yen, Euro CAD, things like that have moved a lot. You're most welcome, Ryan. Thanks for the kind words. Not only could we see higher volatility than that, we could, for instance, we could also see very choppy movements. Look what's going on in recent days. Currently, we have a range in euro dollar of 108.54 to 109.33. That's around 80 pips. We had so many days in previous weeks that we haven't seen 80 pips all day. And usually towards the NFP, we have high tension and the lack of moves, at least until half an hour before the event. So we usually have a very quiet morning. We have lots of this tension in the air about to explode. Okay, now we're already seeing stronger movements. what's going on in the Asian sessions of late is quite interesting, and then it becomes even more crazy later on. Okay, we used to have so many boring Asian sessions. It's not that way anymore. Any more questions? Yeah, I have a question here. I fail to see how the euro is a safe haven flow considering fundamentals, but if the UK never had Brexit, perhaps I could see GBP as a safe haven. Please explain your safe haven. Yeah, actually get this question quite a lot, but I'm glad to answer it over and over again. Yes, it doesn't make sense that the euro is a safe haven. I mean, where did we have trouble in the world and in the economic world in the past few years? In the eurozone. How can it be safe with the Greek crisis? The last episode just last summer, with uncertainty, political uncertainty in France, Spain, Italy, Portugal, and sort of more and more disintegrated eurozone, more fragmented, more falling apart. Well, the cause for the weakness in the euro is also the cause for making the fact that the euro is a safe haven. How does that work? The ECB has enacted two policy measures. The first one began in June 2014 is a negative deposit rate. That means the commercial bank that parks money with the ECB gets punished, pays interest rate. That encourages money to be lent to the real economy or send it out of the eurozone. The same happens with the QE program. The ECB prints lots of money. The euro is, it's cheap to lend in euros. There's too many euros floating around. Money goes into the real economy, into stock markets as well, here in Europe, but also outside, okay? Looking for higher yields, looking for riskier assets. Some of this money goes into emerging markets. But now we're seeing emerging markets, such as China, which is already a huge emerging market, in trouble. And also other countries in Latin America, in Asia, in Africa, perhaps even, in trouble. So what happens in times of trouble? Money goes back home, is repatriated. So perhaps the preferred term is not a safe haven, but a funding currency, a cheap funding currency, and it goes out to riskier assets when we have a good mood and comes back home when we have a bad mood. So perhaps the term safe haven is a bit confusing, but that's a term everybody uses. For the euro, it's a new phenomenon because of the ECB's recent policy. For the yen, it's a very, very old thing. The biggest example was just before the financial crisis, the famous carry trade. Traders were just lending in yen, buying Aussies or Kiwis. The interest rate in New Zealand reached a high of 8.75. In Japan, it never passed 0.5% back in those days of 2005, 6, 7, 8. So it worked very well. You just, as long as the exchange rate was stable, just the interest rate gap made a good trade. But then, of course, everything collapsed. Global financial crisis, money repatriated to Japan. That means that the yen strengthened, shot higher against everybody, and this trade, of course, totally failed. Okay, so that's what happened in Japan. It happened also in the tragedy of the earthquake, tsunami, and nuclear disaster of March 2011. And we're seeing it happen with the euro, but it doesn't happen every single day. Sometimes we have weakness in the eurozone, like we've seen in early this week, on Monday, actually. You're welcome, Fabian. Thank you, Yohay, for completely unpredictable NFP, perhaps given the geopolitical uncertainty, it could even not move at all or just a little. Yeah, because we have so many things going on in the world now that are overshadowing fundamentals. Okay, now non-farm payrolls is still the most important event in the calendar. I still think it has an impact. We've also seen impact from the Fed minutes and other, but just this impact is not as strong as it used to be. And as I said also before, this time we don't have we don't have a rate hike coming up soon. The next probable rate hike will be in March. We just had the rate hike behind us. So it's not that important. It's not it's less, the Fed is a bit less data dependent now. It'll become more data dependent come March, but it's sort of a bit on the back burner. Okay. I'm sure we'll have markets moving a lot, but I don't think it'll take a clear direction. Not necessarily take a clear direction. Something from a previous comment, a Brexit. Yeah, we talked about the danger of a Brexit, EU referendum, remain or leave. So it does, of course, pose a risk to the pound. That's one of the sources of weakness in the pound. And also the Eurozone is a source of weakness for the pound because Britain depends on the Eurozone a lot for its trade. So a strong Eurozone, we're seeing some signs of recovery, could be positive for the pound, but markets are now ignoring that because we have some weakness in the UK, we have this global gloom, and the EU referendum, of course. Yeah, okay. I guess, yeah, it's time for, yeah, let's begin the wrap up and then a preview for next week's events, okay? So this is the wrap up for the live market open on Friday, January 8th. Markets are moving according to different moods. Currently, we're in a better mood than yesterday. China managed to stabilize its stock market, stabilize the yuan, and oil prices are going up. Commodity currencies that suffered a lot managed to stabilize, and safe havens are a bit off the highs. So the safe haven euro currently hugging 108.80 off the highs. We're expecting no significant events in the Eurozone today. Levels to watch 109.50, 110, 107.60, 107.10. Pound dollar, we have UK trade balance. Pound dollar dropped yesterday to the lowest levels since 2010, managed to recover. Currently at 146.15. Levels to watch here, the lows of 145.30, and I would say 147. Still leans to the downside. Dollar yen, the safe haven, made this sort of double bottom at 117.40 when on the bad mood, when things became better. 118.40, some kind of resistance at 119.20 and 120, support 117.40. Dollar CAD went for the sky yesterday. 141.70 was the high with the falling oil prices. Also, WTI crude oil broke the post GFC lows and reached 32.08 currently. With the improvement in the mood, it's currently 33.74. 34.20 is the limit in crude. I would say for CAD, it's 140 as support and 141.70 as resistance, but it's all about oil, and oil. Aussie dollar also yesterday had a bad day, fell below 70 cents, very round number. Retail sales in Australia were okay. Currently 70.33, I would say resistance 70.65 and 71.50. Support at 69.40, low support, which was a double bottom a few months ago. Kiwi dollar 66.46, between 66 and 67. No significant events for the Kiwi today. Of course, the big event for today is the non-farm payrolls. So we're expecting around 200,000. I believe real expectations are closer to 210. I would say that 250,000 and above would be a superb report, and 170 or below would be a disaster report. I mean, a more significant impact. But it's also important to watch the wages, especially if we are within the range. 0.2 is expected on the monthly level, and I think it was 2.3 year over year. Now we're expecting, I think, more of the same. Let's see if we get back to 2.5. This could be a good report for several reasons. Retail hiring in December. Last year we also had a superb report. ADP was a bit high. It also doesn't have the same impact because of several reasons. First of all, the focus of markets on what's going on in China and other geopolitical issues, as well as the fact that we already have the first rate hike behind us. So the second rate hike is also important. So is the third and the fourth, but not as important as the first time. Okay, the first time in 10 years, almost 10 years that the Fed raised rates. Anyway, it's a big event. We could have crazy reactions, especially in safe haven currencies, in euro dollar and dollar yen. It's one of the most complicated reports after an extremely busy start to 2016. Okay, for those of you trading the Canadian dollar, we're expecting the Canadian jobs report. Again, oil prices overshadow the Canadian economy, but it doesn't mean that we won't have an impact. We're expecting there a rise of 10,000 jobs and the stable unemployment rate at 7.1%. Okay, so that's the wrap up for today. Before we move to the preview for next week, we have a few comments here. Okay, the term safe haven not really correct, but it's more reputation of the euro after, say, equity panic and positions liquidated back into euro, hence bad stock market equals euro rise. Yes, unlike what we used to see as a negative correlation to equities. Am I correct? Yeah. In the past, we had the euro moving like any other currency, and the safe havens were the dollar and the yen. Yen remained a safe haven currency. Dollar is sort of now in the middle, and the yen and the euro became a safe haven currency. In the past, we had the euro was a risk currency. Markets were up, the euro was up. Now it's the other way around. Yeah. Another comment here from Ryan. I heard in Bloomberg that average hourly earnings are the important thing to look at. As far as this could be a key indicator of future hikes. Do you agree? It is important. Yeah, I mentioned this. When I talk about wages, I talk about the average hourly earnings. Okay. So that's what I talk when I talk about wages. It's expected to be, I think if we have a blockbuster report or disaster report, wages are less important. If we have sort of more in the middle, it's more important. But certainly, it's important in any case. Just if we have 300,000 or 100,000, let's say, nobody will look at wages. I mean, in the immediate reaction, at least. Okay, so this answers the question. Okay, now let's do the preview for next week. So this is the preview for the week of January 11th to January 15th, which actually begins on January 10th or 9th over the weekend when markets are closed. We have inflation numbers from China. Why am I talking about this? Because China moves markets a lot. So we have to watch out if you're trading on early on Sunday. It's sort of late on Sunday here in the in the old continent. Just as the week begins, this will have the biggest impact on the open if we have better than expected or worse than expected figures. Then this will have an impact on Monday because on Monday we don't have anything really important. On Tuesday we get more interesting stuff. UK industrial output and US jobs. It's another jobs measure. Things become more interesting on Wednesday. Yet again, look at the events I'm highlighting. It's the Chinese trade balance. Not only the balance itself, but the level of imports and exports, which means the general level of activity. More activity, better for the world, better atmosphere. Less activity, worse for the world. And also on Wednesday, another non-economic indicator, if you wish, not a direct one, oil inventories. We've seen how this week we had a fall in crude, but a rise in distillates, and that sent sort of oil prices way down. To the more fundamental fundies, we have on Thursday the Australian jobs report for those of you trading the Aussie, and the rate decision in the UK. No changes expected in the interest rates nor the QE program as usual, but the meeting minutes are released at the same time. We could have an indication if we'll have less chance of rate hike, as we've heard recently from the Bank of England, or her chance. So far we had 8 members voting against the change, including Governor Carney, and just 1 member, Ian McCafferty, voting for hike. Let's see if we'll now have a unanimous 9-0, or we'll have the same voting pattern. That could be a very, very significant event for the pound. Okay, and on Friday, the focus returns to the United States. Retail sales for December with the PPI at the same time. Let's see how the US consumer spent or not so much in December. We have also industrial output to see the fragile manufacturing sector in the United States. And last but not least, the preliminary University of Michigan's US consumer confidence for this month, for the month of January. So we can also have an indication on spending. As we talked in the outlook, the US consumer was expected and still is expected to spend more because of low gasoline prices, but this doesn't really happen. Let's see if now they're more confident or they spent more in December and are more confident about January. Okay, so I guess that concludes the show for today. As always, you can see a recording of the full show, of the wrap-up, of the preview on fxtrade.com. You can also see there the 2016 outlook we did here on Wednesday. Wish everybody a safe and successful day. Be careful with this NFP. It's one of the more complicated ones out there. And and we'll be here, of course, on Monday as usual. Okay, thank you very much, everybody. Thanks for the kind words. And of course, have a great weekend. It's the second weekend of 2016, the first normal weekend, not a holiday weekend. Yet again, thank you very much for coming. Have a great day and a great weekend, and see you on Monday. Thank you, and bye-bye.